Today, we are on a quest. A pretty specific one, actually. We want to find out if one single company can deliver a consistent and, let's be honest, ambitious return for the next 16 years. And the company we've put under the microscope for this challenge, it's Bristol Myers Squibb.
And this right here, this is the number. This is the whole point of our journey today, 9%. That's our target for an average annual return. Every single piece of data, every strength, and every weakness we dig up, it's all going to be measured against this one figure. I mean, let's face it, that's a tall order. Finding a true compounding machine that can pull that off for over a decade and a half is, well, it's tough. So the big question is Bristol Myers Squibb up to the task? Let's find out. So here's our game plan. We'll start by getting to know our subject, Bristol Myers Squibb. Then we'll decode its financials, take a hard look at its strengths and weaknesses, scout for any risks on the horizon, and finally, we'll deliver our verdict on whether it can hit that 9% goal.
Okay, first up, let's properly meet the company at the heart of our quest, Bristol Myers Squibb. You'll see it called BMY. It's a huge player in the global biopharmaceutical world, so let's figure out what really makes it tick.
So what does BMY actually do? Well, to put it simply, they're in the business of selling intellectual property that's packed into pills and injections. They focus on really critical areas like cancer and heart disease. Their whole model is built on patents, which gives them incredible pricing power and, you guessed it, super high gross margins. But here's the catch. A huge chunk of their revenue is concentrated on just a few of these blockbuster drugs. Okay, let's move on and decode the financials. This is where we're going to find the biggest clues in our quest for that 9% return. You know, the numbers don't lie. And we have to start with BMY's superpower, cash flow. I mean, look at that. The company churned out a massive $15.3 billion in free cash flow over the last 12 months. This is the engine of the entire company. It's what funds the dividends, pays down debt, and lets them go shopping for other companies. It's truly the single strongest part of the investment case. But, and this is a big but, here's our first point of tension. This is their return on invested capital, or ROIC. At 7.8%, it's honestly a little below where you'd want it to be for a company that has to constantly spend billions buying up other companies just to keep growing. It kind of suggests that while they make a ton of cash, they might not be getting the most bang for their buck when they deploy it. Now, before we get to our next number, let's do a quick definition of a really useful metric, the PEGI ratio. Think of it as a souped-up version of the classic PE ratio. It's great for companies like BMY because it doesn't just look at earnings, it also factors in the growth rate and the dividend yield. So it gives us a much fuller picture of the value. And BMY's PEG is 2.10, a score above 1, like this one, is a huge signpost. It's telling us that we're looking at a company where the dividend yield is doing all the heavy lifting to provide returns, mainly because growth is pretty slow. For our quest to find a 9% compounding machine, this kind of suggests BMY is behaving more like a cash distribution vehicle. Okay, so let's dig into BMY's competitive advantages, its moats, and its strengths and weaknesses. We really need to understand these because for a company like this, they're often just two sides of the very same coin. This quote from the source analysis just hits the nail on the head. Unlike a company that sells something like soda or sneakers, BMY's core products have a built-in expiration date. They are in a constant, high-stakes race to replace their own revenue streams. It's a tough spot to be in. And this illustrates that life cycle perfectly. BMI builds this powerful moat with a new patented drug, which lets it charge premium prices. But then, the patent cliff arrives. That moat just disappears, generic competition floods the market, and revenue can literally collapse. The only way to rebuild? Spend billions acquiring new innovation. It's a powerful advantage for sure, but it's a temporary one. So when you put all of that together in a weighted SWOT analysis, strengths, weaknesses, opportunities, threats, BMY scores a 6.7. Now that's solid, but it's not exactly knocking it out of the park. It really paints a picture of a balanced company, one with real strengths, but also some very real challenges. So let's dig a little deeper into those challenges.
All right, let's focus on the risks. We need to identify the specific hurdles that could completely derail our quest for that 9% return.
Okay, so understanding these hurdles is absolutely crucial. The patent cliff is the big one. It's basically an existential threat. Then you've got the risk that comes from spending $37 billion on acquisitions. Trying to integrate all that is never easy. And all that spending, it's led to a pretty high debt load. And finally, the company is still just way too dependent on a small handful of blockbuster drugs for its revenue. All these risks create a pretty wide range of potential outcomes for the company's value. The base case valuation is around $61 a share. But if those risks we just talked about, integration, pipeline failures, if those really materialize, the bear case sees the stock down at $42. This really highlights the potential downside we have to think about on our quest.
Okay, we've seen the business model, the financials, the moat, and the risks. We've arrived at the climax of our quest. It is time to put it all together and finally answer our central question. Can we get our 9% return?
And here it is, the answer, laid out in black and white. This table calculates the absolute maximum price an investor could pay today to achieve a specific annual return over the next 16 years. And to hit our target, our 9% goal, the analysis concludes we must buy the stock at or below $49 per share.
And that brings us to the unavoidable conclusion. The current price is $54.65. The price required for our quest is $49. At today's price, the math just doesn't work. The goal is out of reach.
This quote from the source analysis is the absolute perfect summary of what BMI truly is as an investment. It's not a high-growth stock. It's a stable, income-producing asset, kind of like a bond, that also happens to give you a lottery ticket on whether their next big drug is a hit.
So the final verdict is a hold. Look, Bristol Myers Squibb is a cash-generating machine and it's a solid defensive stock for someone who's looking for income. But for our specific quest to find a compounding machine that can guarantee 9% returns for 16 years, it just doesn't meet the criteria at its current price. We want to give full credit where it's due for the rigorous work behind this explainer. The entire analysis, including the valuation and the investment thesis, comes from an absolutely excellent deep dive by Nazim at the website Save, Invest, Compound.
And that leaves us with one final, and I think pretty thought-provoking question. Our quest for 9% really highlighted a fundamental trade-off that every single investor has to face. So I'll leave you with this to think about for your own strategy. What matters more to you? The certainty of reliable cash flow today or the uncertain potential for high growth tomorrow?